So today we're going to talk about intangible assets. This is chapter 12. Excuse me. With intangible assets, they are assets. They provide a future benefit, just like any other asset. They tend to be long-term, and they don't have physical form. They cannot be seen or touched. Copyrights, franchises, trademarks, patents, things like that can be intangible assets. Goodwill is another intangible assets that can come from a merger or a purchase of a company. Generally, it's something we can fall into. It's usually the excess assets over liabilities. There's no amortization, and it can be impaired. So, okay, I'm not sure what happened here. Okay, so goodwill, again, is one of those things that can only come from the merger or a purchase of a company. Goodwill should not be lost, and they used to amortize it over 40 years, but now they're saying you should not lose your goodwill. In other words, if I bought a McDonald's franchise, I have the name, I should be able to keep that goodwill in people's minds, okay? So the way that we expense the intangible asset over its useful life is called amortization. It's similar to depreciation, but because intangible assets have no physical form, they can't be depreciated in the sense like a plant asset is. Normally, with amortization, we use the straight line method, which is very similar to what we did with depreciation. In other words, it's exactly the same, essentially cost minus estimated salvage value over estimated useful life. A lot of the time, there is no salvage value on intangible assets. It is possible, but it's often that's not the case. Now, as your book will tell you, you can credit an account called accumulated amortization, although you don't have to. You have to do it with depreciation because those assets have physical form, and they are harder to reflect market value, where intangible assets, it may be a little bit easier. So we normally just credit the intangible asset when amortizing. So if you look at exercise 12-1 on page 642 of your book, I'm sorry, exercise 12-12 on page 642 of your book, we're going to do a journal entry for the purchase of a company. So it says Brigham Company purchased Young Company by paying $250,000 cash and issuing a $100,000 note payable to Steve Young. So at July 1st, 2017, the balance sheet of Young Company was as follows. So we can see the information there, and it tells us that the recorded amounts all approximate current values except for land. So land, we have a recorded amount of $40,000, but they're saying the fair value is $60,000. However, a company could never just write this up, right? But since the assets are being transferred through a purchase, just like we did with our plant assets, we can change the fair value. Land, of course, is a plant asset. Inventory is 125, and trademarks, that's an intangible asset, are 15,000. Now, since this is a purchase, we're probably going to have goodwill. Okay, so let's say we're going to do journal entry on July 1st, 2017 for the purchase of this asset. Okay. Let me just check back here. Okay. Okay, so 7170. So we're receiving cash of 50,000. So that's going to be debit cash, of course. Accounts receivable. We're receiving 90,000. Now we're receiving inventory, but we're being told the fair value of that is 125,000. So even though they have 100,000 recorded, and we're also being told land has a fair value of 60,000. Okay. So land. So we can already see that there's an increase in our assets. Okay. So something to think about. Now, as far as the buildings and the equipment, those are going to stay at the amounts given. And that's 70. And then we have trademarks. Again, an intangible asset. And we're being told the fair value is 15,000. And we also have to take on this company's accounts payable for 200,000. Formatting there. Now, the stockholders' equity, we would not be taking that on. That's their stockholders' equity, not ours. Okay. Now, it also says we paid cash of 250 and issued a note payable for 100. So let's make sure the entry balances. So let's add up our debits. We get 485. Add up our credits. We get 550. Okay. So that $65,000 difference, that's goodwill. Okay. All right. So what we're going to do is we're going to make another line here because goodwill is an asset, so it should be debited. And you'll see how we just kind of fell into it here. So the difference, right, is the goodwill. So that's going to be debited for 65,000. Okay. So that's often how we calculate goodwill, is through the difference that we calculate. Now, the second part says, prepare the December 31st entry for Brigham Corporation to record amortization of intangibles. Well, the only intangibles are goodwill and the trademarks. We know land, equipment, buildings, those are plant assets. Cash, accounts receivable, inventory, those are current assets. Goodwill is not amortized, so the only thing we have to worry about is trademarks. So on 12/31/17, what we would do is debit amortization expense. And we would credit trademarks. It's much simpler to credit the intangible asset than an accumulated amortization account. Now, companies are allowed to keep an accumulated amortization account, but it's not required like it is under depreciation. So how much amortization do we have? Well, it tells us the trademarks have a useful life of 4 years with a residual value of 3,000, which again is kind of unusual. So the fair value is 15,000, right? Minus the 3,000, 12,000 divided by the 4 years, 3,000 a year, right? We've only had it since July, so it's going to be $1,500. You can see amortization expense. It's very similar to depreciation. In many ways, it's easier to calculate because it almost always uses straight line. There are other methods, but they're not very popular. So thank you for your attention.